Hey everyone, welcome to another episode of the Under the Hood podcast hosted by Stallion Capital. Today on the show, we have Nycole Freer, who is the founder of Eden Financial. Nycole, how you doing?
I'm good. Thank you for having me on.
Of course. No, thanks for coming on the show. And we like to jump right in and getting to know you. And I'm excited to just hear about your take on the current market, the alternatives, but we always love to start with your story. So tell us a bit about yourself, your journey into the financial space. And yeah, we'd love to hear it.
Yeah, so I guess we could go back to like when I was 16 years old. My grandma said, I will match whatever you save by the time that you're 16. And I never knew how to save a dime. I spent all of my money. And then I would watch Susie Orman on Oprah, whether you like her or not. I didn't know anything back then. So I watched Susie Orman. I read Young, Broke, and Fabulous and did my first budget for my mom at age 18 years old. And then I went to college and was interested in personal finance. So I actually majored in personal finance and was two classes away from getting my certified financial planner designation. So by the time that I graduated, I had finished up an intern during the summer and have been in the industry ever since. So it's kind of, why I started. And then also when I was 21 years old, I had about $500 I wanted to invest. And I went to like a local bank and they're like, come back when you have more money. And so I never went back when I had more money. I learned how to do it myself. And then obviously got all these professional designations. I got my Series 7 and 66 and the life and health. So I did all the things I was supposed to do to become a financial advisor so that one, I can learn this for myself and be better with my own personal finances so that I can help other people. And yeah, here I am today, started my own firm in 1 year ago in January 2023. So I'm still standing here and in the business for 12 years now. It's crazy.
There we go. There we go. Well, where were you at before you started your own firm, and then what made you make the jump?
I was at JP Morgan before I made the jump. And when I landed the JP Morgan job, I thought I made it. I was like, this is exactly where I wanted to be. I was making really good money. I was really happy there. But then about 6 years later, I'm like, I want to become now a financial advisor. So from 2012 to 2023, like right before I left, I worked underneath top financial advisors this whole time. So like learning the business, I never want to go out on my own because I was too scared to take the leap and actually have faith that like this could work. And so I never did it. So I always work underneath financial advisors. Anyways, I loved what I did. But then when I was ready to take that leap, it was already a very saturated market. So at Chase, I would have been starting in a branch and there's already at least one advisor already in a branch. So it's highly competitive and I would have had to take a pay cut. But it's like, if I'm going to take a pay cut, I might as well just take a pay cut for myself and then not earn a percentage of the investable assets. Like now I get to take like all the percentage of the investable assets now that it's my firm. And I get to hustle and work hard like for myself and for my business. On top of that, I wanted to have a big social media presence and having compliance, in your back door, always telling you what you can and can't post. I'm like, you know what? I just need to start my own firm. I'll be my own compliance. There's other marketing professionals out there talking about personal finance and making millions of dollars. Like, why can't I do that too? Not that that's happened yet, but I mean, I was like, that was kind of a thought. It's like, there's non-professionals talking about finance out there. Why can't that be me? So anyways, that's kind of why I started my own firm and starting like my own brand. And yeah, that's just what I wanted. I wanted to have autonomy and make more money in the least amount of time. I took one step forward, so hopefully take a bigger leap forward in the future.
Yeah. Yeah. No, absolutely. That's real cool. And so I guess we got a pretty good picture of how your financial journey started at 16. You were really getting into it at 18 when you did the budget. You went to college for it, worked under top professionals in the space for like 12 years until you launched into your own firm so you could have some brand freedom there and, also reap all the benefits of your actions, if you will. That's really cool. Now, I'm curious. you mentioned how non-professionals in the finance space who are marketers are making millions of dollars. So is the only thing that you do kind of some fee-based financial advisory, or is there another component as well? Talk to us a little bit about that.
I am fee only, so I do investment management and I also do financial planning. So I do both. So both ways of making money. I don't take any commissions. So if I sell you something like life insurance or disability or an investment product, it's not because I'm earning any sort of kickback. It's because I really do believe that it's in the best interest for the client.
Yeah. Yeah. No, absolutely. I love that. And where do you go to kind of stay up to date with the best financial strategies and the current market trends today?
Yeah, so I attend the quarterly meetings at the Financial Planning Association here in Orange County, and I stay up to date there with some of the sponsors that come, and then they present on what they have, which some of it includes alternative investment strategies. Um, I also stay up to date by listening to a guy on YouTube. Um, I mean, aside from like all the normal traditional stuff, like Schwab's marketing coming through, First Trust marketing email newsletters coming through, like on top of staying on top of all of that, then yeah, I do also listen to a guy on YouTube that is sharing, politically what's going on. Cause I also want to be informed, not just like in the finance space where all of these like big professionals are, but I also want to hear like another side so that I'm not blindsided. I want to have a really open mind to what's going on in the world. And that's how I stay up to date.
No, that makes a lot of sense. Who do you listen to on YouTube?
Um, his name's George something. I get his emails. I can look it up. Do you want me to look it up?
No, that's okay. We'll put it in the show notes after the show, if we remember. That's cool though. I like the diverse approach, right? Because you can get all the normal stuff, but then because you get the normal stuff, you break it down into a couple bullet points, and you can speak that to your clients, or stay up to date that way. Or you could have that and add a little color, add a little flavor in there by getting some other perspectives, because there's never a one source of information is the best source of information. You have to put it all together and kind of curate your own opinion of what's going on in the market. So I like that you have the
Oh,
diversity of
thank you.
YouTube in there for sure. Well, cool. We'd love to jump into kind of insights on the current market. Speaking of where you get your information, what are you really paying attention to in today's markets? What factors of the market are you most interested in?
I'm most interested in the equity market. And speaking of the fact that we're talking on this call about, I believe, alternative investments, I do love alternative investments. And I also like the equities market. I'm starting to get away from the bond market, getting ready to, make moves out of there just because of what's going on. But as of right now, the stock market is just continuing to go up and up. And if you're not playing in that right now, like you're missing out on like what you could be, what you could have if you're just playing it safe, like sitting in a money market or any sort of bond right now. So that's my where I'm putting my clients right now is I'm like it's either dividend focused or equities for focused growth. And there may be a time in a few months or in a year where I'm like, okay, guys, let's get out and let's make a move. But as of right now, that's where I'm heading. And then for my clients that have a bit more money, then private equity is where I'm at. So Fairbridge Asset Partners, they do a bridge lending strategy that I love. So they really are only on the hook for about a year to 2 years for construction loans, which I love. And the you're familiar?
I mean, yeah, that is basically what Stallion Capital
Oh, yeah?
does. Yeah.
Okay, so
Yeah.
then it's great because, like, the customer is getting around 1%, every single month from the interest that's being paid, and like, a lot of banks aren't really lending as much, so going out to private money is kinda where it's at, and then on top of it, this company, you can say if your company does this as well, that, like, if those people don't pay, then Fairbridge gets to keep that property now. So they only leverage about, I think they're only giving them about 40 to 60%, and that's about it. So it's relatively safe. You can't say that it's safe, but it is, I believe, relatively safe. And, last year the people that were in it made around 13%, and that's pretty incredible. I mean, it's a complement to the equity market, right? Because like equities also did really well. But then when equities begin to go down, then sometimes these are safer investments because it's not so much of a decline. So
Do they specialize in a specific type of construction? Like, is it single family? Is it multifamily? Is it more commercial?
more multifamily, but they are getting involved in like, I think they mentioned like mobile homes or like manufactured home properties now, and like just getting into other real estate space. So but their main one is really like the apartment complexes, like buying them, refurbishing them, and then getting them off their books so then they get refinanced into like a 30-year mortgage, and they just keep doing that. So yeah, I mean, I don't know if you want to share more about your product and like other people are interested, or that's for another call.
No, no, for sure. I'd love to jump in. I mean, Stallion Capital is like a very, very similar product. We do 12 to 18-month loans on primarily single family residential in Texas, kind of up and down the I-35 corridor, all with builders, developers, and flippers that we have worked with before. Well, 60% of repeat borrowers because we've been in the Austin area for the past 17 years. So, I mean, when I say the strategies are similar, I think the only difference might be the asset class and maybe kind of distribution timelines. Like they do it monthly, we do it quarterly. We have a little bit higher LTV on some of the projects. Like I think theirs, you said, was 40%
It's either
is
40
all
or
they'll give.
60, I forget.
Gotcha. Yeah, we're more around that average of like 62, and we'll be max 70% LTV on some of our projects. But yeah, it's kind of that stable, consistent return. And, we're more in that 8% range. So I'd actually love to um, pick your brain more about their strategy because 13% is very nice for an annual return on a private debt fund in real estate. But
They actually kind of like it when the borrower goes into default because now the interest rate gets really much steeper. So, yeah. I don't know, maybe the interest rates are just a little bit, maybe the interest rate's higher on their end versus your end, possibly. I'm not sure.
um, you know, I would be
Or it's competitive.
I'd be shocked if it was.
Yeah.
I'd be shocked. I'd be shocked if theirs was higher. But I will say there is that kind of lend 40%, you get a REO back, and if you finish that property and sell that property, it really boosts the returns. And I think a lot of our projects, especially in multifamily, um, and like mobile home parks, you'll get a higher multiple on those properties when you have a value add project. Whereas in single family residential, it's kind of more loans at a smaller loan size with less upside on the finish of an REO. So maybe that's the difference
Maybe.
um, in the two strategies. But
I could
you know,
connect you with the guys if you want to connect.
yeah,
I
yeah,
don't care.
yeah. We'll talk about it after.
Okay,
Yeah,
sounds
maybe
good.
maybe we'll get a connection going there. Pick their brain on the strategy.
Yeah.
But that's really cool. So you have the equities market where you are, picking stocks for dividend purposes or for growth purposes. Are you picking individual stocks? Are you going into indexes? Like, talk to us a little bit about that.
Yeah, so I actually use another company to manage my money. So Zacks Investments is who I use for my focus growth strategy, also dividend focus, things like that. So they're really the guys that are buying and selling. I love them. So I'm just like your quarterback saying like, hey, you should go into this fund, or a money manager fund. So, and they're very competitive on their expenses. And then for some of my other stuff, I also use Dimensional. And I really like them, low cost. I like their story and how they're buying based upon price. And so I guess essentially value. So I let the experts that have the CFA do their job. And I'm more like financial planning focused and putting the client in the right sort of investment strategy that I believe is right. And then having them manage within those guidelines. Those, they're if they're focused growth, then they should be focusing on that. Or, if it's I think Dimensional, I use sustainable growth, I believe, on their end. So focusing on sustainability of the portfolio.
Yeah, yeah, no, for sure. That makes a lot of sense. I like that strategy because it also allows you to be more client facing and client kind of focused instead of, hey, I'm client focused here, but I also need to manage these investments and make sure I'm talking with sponsors and make sure I'm doing this and doing that. And that can be a whole job in and of
Like
itself. And the due
totally.
diligence on some of these alternatives, let's not even get started there.
Yeah, seriously.
So yeah, no, that's really cool. So you kind of moving away from bonds, you have managers for the growth side or the dividend side that will kind of their whole job is to manage that well, and they minimize the fees to maximize the return to your clients. And so when you're looking at a client and they come in and they're like, hey, I want to go into asset accumulation, or I want to go into kind of a retirement version of this or an income version of a portfolio, what percentages are you kind of allocating to the growth, to the dividend, to the alternatives? Kind of how do you think about constructing that plan with them?
It really depends on the type of income that they need. So if they're really using the income from their portfolio, then I'm going to go out and try to find income focused mutual funds, ETFs, alternative investments to help make up what they need. So really just it's so customized, right? Like I have an 82-year-old client. They just wanted income and preservation of capital. So that's very customized and how I had to go approach that and what to find. Um, and then I have some of like my younger clients that are getting ready for retirement, but like I also have to let them know, hey, like you have to outlast this or your money needs to outlast you, like in a sense. Because like I talked to a guy today, 57, and I asked him when his parents passed, I'm like, so you're gonna live like at least another 30 years. So like you have to let that money last. So if I'm able to get his money, it some of it's gonna have to be growth for focused, and then some of it is gonna be like more immediate. So it'd be more like probably, hey, make sure you have a year to 2 years worth of savings in the bank if you're gonna, retire and you're gonna need this money, then put that aside. And then it's I'm kind of basic, like the whole buckets approach. I really kind of like that. If we're looking at someone like basic like this, the, you know, put away 1 to 2 years, you have your bucket for, the next, I don't know, 3 to 7 years, and then you have your next bucket for like long term money. So I'd probably really take that approach. And in my bucket number two for like the 3 to 7 year, I would use probably something like the private equity or something like this,
Like Stallion
like
Capital.
selling capital to help to increase income, but then also at like preservation of capital at the same time. Cause like we don't have like a full 10 years to recover. Like if we do have a market downturn, we don't have that time to get that money back. Like if we had an '08, for example. So, um, yeah, just being cautious of like what's going on in the market, what's going on in the world. Um, I even like be like, hey, if you have some extra money on the side, like maybe you should go buy some silver, gold, just kind of stash it away. Like I'm not a doomsayer, but like just in case, like same with Bitcoin, like have a little bit of it just in case. And then we focus on kind of like what we know from our past and the history of investments. I mean, past results don't equal future returns. However, like it's a good indicator. So, anyways, all the stuff that we already know.
Yeah, yeah. So you have 57-year-old clients buying a little bit of Bitcoin, it sounds like.
Yes. uh,
There we go. There we go. Hey,
yeah.
I'm a fan. I'm a fan.
I mean, just like a little bit. I mean, I'm like, how much money can you lose? Okay, if you can only lose $100, let's put in $100. If you can only lose, whatever that amount is. But let's be a little bit in it just in case it pops. That'd be kind of be nice.
Yeah, yeah. So would you say, maybe we don't have to go here, but would you say you're overall kind of bullish on the cryptocurrency technology and kind of the idea behind it and that it's going to integrate into society? Or would you say you're still kind of trying to suss it out and do some research, but it seems promising right now enough to put 0.5% of the portfolio or something like that.
Yeah. I don't know what will happen. It's possible that we're gonna go this way in the future. So, I mean, it's been doing really well. So there's just a couple that I have my clients in, and I use another money manager for Bitcoin or the Ethereum and things like that. So they're also watching over it, just in case.
Yeah, and I mean, we're not here to endorse anything, but we did have a guy on the podcast who was all about
Oh,
Bitcoin,
no way.
actually. I'm pretty sure he was a professor,
Oh, wow.
um, of Bitcoin at a university,
No
and he
way.
kinda landed that gig. He used to be, and then he has something for financial advisors actually now that teaches them about Bitcoin, and I'm pretty sure it's a part of continuing education
No way.
for financial
Oh, that's
advisors.
good to
So,
know.
yeah, if you want to meet him or learn a little bit more about it, so you
So is he bullish?
um, he is very bullish.
Right.
He
Nice.
is
Good to know.
very bullish.
Okay.
Yeah. He had me drink the soup a little bit
Oh,
on the
good.
show,
Okay.
because of how he was talking. Just he got into like fundamentals of money and this and that and this and that, which
Yeah.
I'm sure you've heard stuff like that before, but
Oh, yeah.
he was very bullish.
Awesome.
Um, well, cool, cool. So I think we have a good idea of kind of your portfolio construction. You have the bucket approach, which is like now money, midterm money, long term money. What percent of the portfolio? So after the 1 to 2 years, are you putting 80% of the rest of it into 3 to 7, and then 20% into the really long term, or how does that kind of breakdown happen? Is it dependent on the client? I assume.
Yeah. I'd say it probably depends on the client, but, like, are they working? How much income do they need? But yeah, probably, I don't know, like, if this client has like 250,000 put away, I don't know. Yeah, I guess it just really depends. Like, I'm just trying to think out loud here. Yeah, so like 20, yeah, and then like a 40%. Yeah, it'd probably be something like that, like a 20% for the first 1 to 2 year, maybe 40% for the next 2 to 7 years, and then beyond that, like another 40%. So guess that kind of gives you your 80/20
Just
model.
general outline. Nothing crazy. You're
Yeah.
not stuck to that, but it's a general kind of
Yeah.
outline.
To be honest, like my main focus is young families. So don't do like so much retirement planning. Although like that's kind of like where the money's at, like for our younger folks. Like they're few and far between the younger folks that do have a lot of money. But I joined Smart Asset for like lead generation. So I do get like retirement people, and my lead gen is for people with less than 250,000. So I'm helping like these types of individuals and like what kind of they're struggling with, and they really haven't saved enough. So like it's kind of having that conversation.
I'm curious. As part of that conversation, sometimes finding ways for them to just increase income, because I feel like if you're doing planning for somebody who makes 40,000 a year and lives in Austin, Texas, there's just some kind of baseline things that aren't really setting them up well for success there. So talk to us a little bit about that.
I mean, it's really just like, hey, let's look at our expenses. Let's try to reduce them. Let's just, even if you could do $25 to $50 a month of starting to save, like, let's just get that working. And then, I have a guy in San Clemente here. He's like 47, saved about $50,000 so far at 47 years old. And I'm like, saving anything is better than nothing, but we really need to work on getting your savings like way higher. So, because like maybe they don't realize they're just living day by day and they're like moving along, and then like it hits them like, oh shoot, I want to retire in the next 10 years. How am I going to do that? Or 20 years? So that is a difficult conversation, but it's like, I also don't want to scare them at the same time either. Like, hey, you're going to need to save like a lot more money than you are now. Um, and like, oh, that's impossible. But to give hope, but also like, hey, let's figure this out, because like if that's really what you want, like we need to get there.
Yeah. Yeah. No, absolutely. That's really cool. It's cool that you have the opportunity to have those hard conversations with people. And I do want to dive into that a little bit more later in the show, but I want to jump back to alternatives real quick. We've talked a little bit to that one kind of real estate debt fund. What was their name again?
Oh, Fairbridge?
Fairbridge. Yeah, we talked a little bit about Fairbridge. I just want to know like how you go about evaluating alternative investments like that. Like, is it a deep dive into the sponsor, into the opportunity, into a little bit of both? Do you look for more of a fund of funds approach? Talk to us about that.
I mean, I'm looking at like the core fundamentals. So like when I listen to their presentation, how how frequently are they going into default? And like what's their risk to going into default and like how bad that could look? So I kind of look at that. And then like these guys were getting like over 300 applicants. I forget what the time frame was, but they like maybe over a year. But they only took on 60 of those. So they're really only working with like high quality people because they can pick. And I really liked that. And then the fact that their performance and like their history of their performance was really great as well. So that's kind of what I look at is like performance and then default. Like how, you know, like if this went wrong, like how bad could this look? So just looking at those types of factors.
Yeah, makes a lot of sense. A little bit of what's the upside, what's the downside, what's the is it worth it, if you will.
Exactly. Yeah.
Talk to us a bit more about what role alternatives like that play in your kind of portfolio allocation because they're returning 12, 13%. That's like right in between kind of a fixed income and a growth. Like I wouldn't say it's, some private equity funds do 20%, 25%. So it's not full on growth, but I wouldn't say it's full on like fixed income either. You're kind of right in that sweet spot. So what role are alts playing in your mind?
Well, it goes back to if you lose 30%, you have to make up like another 45% just to get back what you lost. So by having alts in your portfolio, it's trying not to lose as much. So when you have it, it's compounding versus when it drops, now you have to make it back up again. So that's kind of like my thought process is to not lose a lot and then to be in these different areas, diversify your portfolio, be in different areas and not be stuck into one, like all equities. Like, hey, let's do some fun stuff. Let's get into like some alternatives. And I like that. And, we at JP Morgan, we didn't really do a lot of that, like on the Chase JP Morgan side. We were just getting into it, like as I was leaving, getting into like Blackstone, real estate, things like that. But, I didn't really have that opportunity until starting my own RIA, where now I'm able to listen to what other people have to offer, such as like your firm or some other guys and Fairbridge. So yeah, just cool stuff out there. And like even what else comes to mind is CIM Group. They have a real estate fund and like at a minimum you could be invested in there for 2,500. So like if you wanted to get into real estate and you didn't have 25,000 to like jump in, put all your money in, like a pool of assets, like you could start here and that's kind of nice, and people just kind of get going. So like if my focus is like kind of on these younger individuals, then like what's your minimum for your company?
Yeah, so our minimum you have to be an accredited investor, which, if you guys listening don't know, it's a million or more in net worth excluding your personal residence or 200,000 in income if you're single for the past few years, 300,000 if you're married for the past few years. So you have to be accredited and it's 100,000 is the minimum.
Okay, perfect.
Sometimes we'll bump it down to 50
Mhm.
if people understand that the relationship will eventually get to 100. Like if they plan on a 5 or 10 year relationship, it's like, okay, we'll take 50 now, but we just want to make sure that people are kind of in it for the long term and they're not trying to use us like a money market because it is kind of that 18-month initial commitment period. So yeah, that's why we up the minimums to 100, but we don't mind taking 50. Just has to kind of build over time. So
Totally. I love that. Yeah. So yeah, same with Fairbridge. They're also 100,000. Same, you have to be an accredited investor. Um, but like CIM, like I said, is like you don't have to be accredited, so you can at least like dip your toe in and you can get started at $2,500. Like that's great.
Yeah, yeah. I was gonna ask if you had to be accredited, but I guess at that $2,500 mark, definitely not.
It's
Th
like a mutual fund,
Yeah.
essentially.
Gotcha,
So,
gotcha.
yeah.
Makes a lot of sense. But do they own assets under it? Own real estate assets under
Yeah.
it?
So, underneath them, they own mainly residential real estate. That's, like, their main focus, and then I guess they're starting to do, like, private money now too underneath them. Not too much commercial. I think he said they have about 10% commercial on their books. Because I was really concerned about that. I'm like, "Hey, I wanna get out of commercial, so how much do you have in commercial? Otherwise, I'm getting out of your fund." And he's like, "We're really not a lot into commercial right now." And I'm like, "Okay, well, that's good." So, anyways, yeah.
Makes a lot of sense. Well, cool. So the role of alts is mainly to kind of smooth out that returns ride and keep it up and to the right so you never lose money, so you never have to recover, to keep it compounding, kind of some uncorrelated assets, if you will. We've talked about real estate alts. Are there any other? We've talked a little bit about Bitcoin as well. Are there any other alts that you find interesting that you want to learn more about in 2024?
Yeah, well, I'm always, like, learning, so I don't know what I don't know, right? So, another one that actually just came to mind that I totally forgot about that one a couple of my clients are also in is, private equity. So, actually owning private companies. There's more private companies out there than there are actually on the stock market, which I'm sure you already know. But I do like that space, and, for some reason, I'm blanking on the fund manager right now, but I do really like them. 2023 was kind of a bad year for private equity. Didn't do so well, which kind of was a bummer because the equity market killed it, as you know. So it's hard to like tell my client, like, hey, in the past it's done really well. So last year it just really kind of wasn't so hot. But he's like, basically, he's like, this is not in the same class. So, like, this isn't going to go down as much as your equity. So, this is like kind of your safety when things go wrong. So, it's just nice to have. Yeah, you'll have to let me know if there's any other, asset alternative investment strategies out there that like I'm not aware of, and you think that like I should be aware of it for some of my clients
Yeah,
besides
for sure.
your strategy.
Yeah, no, there's a company called Factright. Have you ever heard of them?
Mm-mm.
Mm. They like help source and do due diligence on alternative fund managers. And so I'm sure they have like a plethora of alts and they host a conference. Stallion Capital is going to be a sponsor at that conference in the next, I think it's like 5 or 6 days is when we'll be there. Yeah. So we'll have a booth there and there'll be a bunch of other alts there as well. And I'm sure there's like alternative energy. I'm sure there are some oil and gas guys that go. I'm sure there are, plenty of alts there. But yeah, there's some good sort. Have you heard of iCapital?
Mm, I don't think
Mm.
so, but maybe.
Yeah,
No.
they're also just kind of they bring a bunch of alts together, but um,
All right.
yeah, it's like you just get some more deal flow, if you will. But yeah, that other than that, I can't think of any off the top of my head. If I ever do think of some, I will definitely send them your way. I do want to jump a little bit more into kind of the client focus. We talked about how you construct portfolios, how you do alts in their portfolio. But what do you think is really most important to that client advisor relationship?
I think it's so silly. Communication. So, I think that's like the most important. If a client calls, like they expect a call back. If they text you, they expect a text back, So just really being on top of it, and then also being on top of like the implementation. Like we did this financial plan, we need to implement it, and then like creating those check boxes. Okay, like we did this, we did this, we did this. Um, so I just think like staying on top of it and the follow up, all those things is really, I think, the most important thing. And then obviously having good returns is also really great. Like if your returns kind of suck or they're comparing it with someone else's returns, um, I think they're like, well, hey, my financial advisor did this last year. I don't know what your financial advisor did. So I think that's also pretty cool. to be able to say like, "Hey, we did well last year for you."
Yeah. So having some competence, having some communication there that is clear and quick. Yeah, I like that. It's really the simple things
I
in
know, right?
relationships, like communication. It's like, yeah, I'm just gonna text you back when you text me. I'm gonna call you back. It goes a long way over time. So
Or
that's
like
really cool.
just a quick like, "Hey, I can't get to it right now, but like can I get back to you tomorrow?" Or just,
Hmm.
things like that. Cause I mean, we all like if you text somebody and they don't respond back to you, you're like, "Okay, like they haven't texted me back yet." But at least they know like, "Hey, I got it," and they're gonna get back to me, and then you can kinda like, "Okay, that's off my plate."
Yeah, yeah, no, absolutely. And if how can people really tell you apart from other financial advisors?
Well, I'm a female in this industry.
That's very
There's
fair.
not
Yeah.
too many of us. There's also not too many female CFPs either. So, and then also I'm young, relatively young. I mean, I didn't jump in the business when I was 20, so I waited until I was 33 to start my business. So, yeah, so like I'm young and then I also like have a heart to help people. So it's not like I'm not like here to like make I mean, I like to make some money, but like I'm really here to like help people and like the money just comes. And I'm also very patient. I love like the older ladies. They like to talk a lot and I'm here for it. So I think that's just like what makes me different is like empathetic and compassionate for people and just like really wanting to help them, whether or not they have like a ton of money. And that's kind of like why I do my like a small fee for financial planning. I'm like, hey, just for me to look at your stuff, like here's the fee. Just because I also in the beginning when I started my business, I was kind of doing a lot of stuff for free. And I'm like, hey, like just so I can make a little bit of money, like this is what I charge. So anyways, I feel like that's what makes me different. I'm not like crazy expensive and I'm really here to help the people that like they have like most financial advisors have minimums and like I don't have a minimum. So I'm really here to help those people. It's like what the 90% of the US that like needs the help. They're not in the top tier that like most people are going after. But I don't
Yeah.
discriminate. I still like the 10%, but I still want to help the others.
Yeah. Yeah. No, absolutely. I like that. And honestly, you sound like a person that somebody would want in their corner. Those are like obviously good returns matter, but somebody you can trust, somebody that's patient, somebody that cares. Those are the things that are really important.
Yeah, thank you
Well,
so much.
cool. Nicole, is there anything else that you want to chat about? Anything you feel we left out before we kind of wrap this up?
Not really. I thought you did a great job. I mean, I guess like if anyone wants to follow me, I'm on social media at Nicole with a Y Freer. So NYCOLEFREER is my handle, and you can find me on all social media platforms.
Perfect. Well, all of those links will be down in the show notes. That was literally going to be my
Oh,
last and
I'm
final
sorry about
question. So
that.
I know I'm glad you just jumped to it. All the ways to find Nicole will be down in the show notes. Website will be there as well. Nicole, thanks so much for coming on the show.
Thank you so much for having me.
Of course. And everybody else, thank you for listening. We will see you guys on the next one.